The past week was chaotic, full of confusion and uncertainty. Yesterday, Donald Trump suspended the 25% tariffs on Canada and Mexico, the same ones he had imposed just 2 days earlier on a Tuesday. At the same time, he promised to launch a global reciprocal tariff regime against all U.S. trading partners starting from April 2. As a result, markets went into a tailspin, and this is a terrible, terrible backdrop for investors. It's hard to disagree with the IG analyst Tony Sicamore, who pointed out that the shifting sense of the US tariffs are turning into quicksand, dragging down businesses in the US, Canada, and Mexico. Meanwhile, investors are left struggling to understand what Trump actually wants. The president insisted that America's trading partners and allies are thrilling at the expense of the US. To stop them from draining American wealth, he is pushing for total trade tariffs against everyone. But there is a big difference between shouting random numbers and slogans from the podium and actually crunching the real economic numbers. No wonder the US economy is on the brink of a recession while stock indexes are plunging. Curiously, the US dollar is not rising either. After all, most of the negative factors have already been priced in, and the postponement of the tariffs could even be seen as a positive for the greenback. Nevertheless, ahead of the NONFARM payrolls for February, the US dollar is trading in the red, fluctuating within the range of 103.50 to 104.20. Against this backdrop, the release of the US employment data for February had the potential to trigger another tsunami on forex. The worst-case scenario would be lower than expected job growth combined with the higher than expected wage increases, as this would leave the Fed Reserve facing a flagging economy with limited options for support. Meanwhile, the Eurozone is pushing for peace while its central bank is braced for a trade war with the United States. On Thursday, the European regulator once again cut its refinancing rate but warned of a phenomenon uncertainty in the markets and the risk of a rising inflation, mainly due to the trade tensions and the growing defense spending. Moreover, the creation of Germany's 500 billion euro infrastructure fund and the announced reforms and also expected to fuel inflationary pressures. Germany is going to flood the world with the euros and encourage spending. In this context, the single currency soared by 4.3% to peak levels of its popularity. The euro-dollar pair surged to levels last seen in 2009, reaching 1.0840. Interestingly, oil barely reacted to the dollar's decline. On a Friday, Brent crude remained near its 6-month lows, trading in the range of $69.20 to $70.80 per barrel. The main reason for this narrow range was, of course, the chaos surrounding Donald Trump's trade tariffs. Oil prices are under pressure due to the fears that Washington's aggressive trade policy could trigger a global trade war, negatively impacting global fuel demand. Besides, OPEC and its allies plan to gradually increase production volumes, and that could happen as soon as April. As a result, crude oil may register its sharpest price drop since October last year. By the end of the week, the ruble asserted its strength significantly. However, its current growth appears overbought, especially against the backdrop of ongoing geopolitical uncertainty. On a Friday, the dollar-ruble pair entered a correction phase, trading in the range of 88.3 to 89.4. Experts see this as a speculative correction, since fundamental factors have not changed much. Meanwhile, the ruble-denominated oil price continues to decline currently, trading 10% below the budgeted parameters. So that's all for today. We continue to follow developments in the financial markets. Subscribe to our channel and follow news with us. See you soon.